Question 1. Which of the following is not a characteristic of proportional reinsurance contracts? A. The reinsurer assumes a fixed percentage of the insurer's losses and premiums. B. The primary insurer is responsible for all losses beyond specified limit. C. Both the insurer and reinsurer share the premiums and claims in proportion to the agreed percentage. D. The reinsurer's liability is based on fixed share of the losses, regardless of the amount. Answer. B. The primary insurer is responsible for all losses beyond a specified limit. Explanation. Proportional reinsurance contracts, such as quota share and surplus share, involve sharing both premiums and claims between the insurer, cedent, and the reinsurer in proportion to a predetermined percentage. Option B describes a characteristic of non-proportional reinsurance, such as excessive loss, where the primary insurer retains risk up to a specified limit and the reinsurer is responsible for losses beyond that threshold. Therefore, option B is not a characteristic of proportional reinsurance. Question 2. Mr. Evans is negotiating a reinsurance treaty with a reinsurer for his company's excessive loss coverage. He wants to ensure that the reinsurer covers losses above certain threshold and that any losses below that threshold are retained by his company. Which of the following reinsurance types would best meet Mr. Evans' needs? A. Quota share reinsurance. B. Excessive loss reinsurance. C. Stop loss reinsurance. D. Surplus share reinsurance. Answer. B. Excessive loss reinsurance. Explanation. Excessive loss reinsurance is a non-proportional reinsurance arrangement where the reinsurer covers losses that exceed a predefined threshold or attachment point while the insurer retains losses below that threshold. This is exactly what Mr. Evans is seeking: coverage for larger losses beyond a set limit with retention of smaller losses. Quota share, surplus share, and stop loss reinsurance are structured in a way that would meet his specific needs for excess coverage. Quota share and surplus share are both proportional forms of reinsurance, while stop loss reinsurance offers coverage when overall losses exceed a specific percentage of premium, not necessarily based on individual large losses. Question 3. Which of the following is true regarding the role of actuaries in reinsurance pricing? A. Actuaries focus primarily on the legal aspects of reinsurance contracts. B. Actuaries use statistical models to estimate future losses and set appropriate premiums. C. Actuaries are responsible for negotiating the terms of reinsurance treaties. D. Actuaries evaluate market conditions without considering historical loss data. Answer. B. Actuaries use statistical models to estimate future losses and set appropriate premiums. Explanation. Actuaries play a crucial role in reinsurance pricing by using statistical models and loss data to estimate potential future claims. This helps in setting the appropriate premiums for reinsurance contracts. They rely on a variety of actuarial methods, including loss modeling and catastrophe modeling, to assess the risk. Set premiums accordingly. Option is incorrect because actuaries do not focus on legal aspects of contracts. Option C is incorrect as actuaries are not directly involved in negotiating treaty terms. This is typically handled by brokers and underwriters. Option D is incorrect because actuaries rely heavily on historical loss data and current market conditions to determine pricing and reserves. Question 4. Which of the following best describes the role of reinsurance intermediaries in the reinsurance market? A. They assume a portion of the risks from the insurer in exchange for a premium. B. They assist in negotiating and structuring reinsurance contracts between cedents and reinsurers. C. They handle the claims settlement process between the insurer and the reinsurer. D. They are responsible for setting reinsurance premiums based on historical loss data. Answer. B. They assist in negotiating and structuring reinsurance contracts between cedents and reinsurers. Explanation. Reinsurance intermediaries, often known as brokers, act as intermediaries between the primary insurer, cedent, and the reinsurer. They assist in structuring and negotiating reinsurance contracts, ensuring that both parties agree on terms, conditions, and pricing. They are not directly responsible for assuming risks or settling claims, option C, nor do they typically set premiums, option D, which is the responsibility of actuaries or underwriters. Question 5. A reinsurer's obligation in proportional reinsurance arrangement is to A. Only cover losses that exceed the primary insurer's retention limit. B. Assume fixed share of the premiums and losses as defined in the contract. C. Retain all losses below the primary insurer's retention threshold. D. Offer coverage for only catastrophic losses, regardless of the amount. Answer: B. Assume a fixed share of the premiums and losses, as defined in the contract. Explanation: in a proportional reinsurance contract, e.g., quota share or surplus share, the reinsurer agrees to cover a fixed share of both premiums and losses in accordance with the terms of the agreement. This share is typically specified in terms of a percentage of the total premiums and claims. Options A, C, and D describe characteristics of non-proportional reinsurance, where the reinsurer only covers losses beyond certain thresholds or specific categories of risks. Question 6. Which of the following is a key advantage of non-proportional reinsurance for the cedent? A. The cedent retains a greater portion of the risk but benefits from lower premiums. B. The cedent is protected against extreme losses above a certain threshold without sharing a percentage of normal losses. C. Non-proportional reinsurance always results in a higher share of the premiums for the cedent. D. The cedent is responsible for underwriting and pricing the reinsurance contract. Answer: B. The cedent is protected against extreme losses above a certain threshold without sharing a percentage of normal losses. Explanation: non-proportional reinsurance, such as excessive loss reinsurance, provides coverage to the cedent for extreme losses beyond a specific threshold. The cedent does not need to share a portion of the normal losses, only the extraordinary ones. This protection allows the cedent to manage catastrophic risk without to cede a percentage of all premiums and losses. Option is inaccurate because cedents benefit from protection against extreme losses rather than simply retaining more risk. Option C is incorrect, as non-proportional reinsurance does not inherently affect the cedent's premium share in the same way proportional reinsurance does. Option D is incorrect because pricing and underwriting typically fall to actuaries or underwriters, not cedents in the case of reinsurance contracts. Question 7. Which factor is least likely to impact the pricing of reinsurance premiums? A. Loss experience of the cedent and reinsurer. B. Current market conditions and supply-demand for reinsurance. C. The reinsurer's historical return on investment and solvency ratio. D. The age and reputation of the primary insurer. Answer: D. The age and reputation of the primary insurer. Explanation: the age and reputation of the primary insurer do not directly influence reinsurance pricing. Reinsurance premiums are primarily affected by factors like the loss experience of both the cedent and the reinsurer. Option A, current market conditions. Option B, and the reinsurer's financial health, including its solvency and investment returns. Option C, while the prime insurer's stability may indirectly affect reinsurance contracts, their age and reputation are generally not significant determinants for premium calculation in reinsurance pricing. Question 8. Which of the following is an example of a claims-made reinsurance contract? A. A policy that only pays claims if the loss occurs during the policy period, regardless of when the claim is made. B. A policy that covers all claims made after the policy period ends, regardless of when the loss occurred. C. A policy that pays for losses during the policy period, but excludes claims made outside the period. D. A policy that provides coverage for claims made and reported during the policy period, regardless of when occurred. Answer: D. A policy that provides coverage for claims made and reported during the policy period, regardless of when the loss occurred. Explanation: a claims-made reinsurance contract is designed to provide coverage for claims that are made and reported during the policy period, regardless of when the loss itself occurred. This is a key distinction from occurrence-based policies, which cover losses occurring within the policy period even if the claim reported later. Option D correctly describes a claims-made contract. Options A, B, and C describe variations of occurrence-based or other forms of claims coverage. Question 9. When structuring a catastrophe reinsurance treaty, which of the following is a primary consideration for the reinsurer? A. The total premium paid by the cedent in relation to their total policyholder base. B. The frequency and severity of natural disasters within the geographic area. C. The reputation of the primary insurer and their historical underwriting success. D. The financial solvency of the cedent and their ability to pay claims. Answer: B. The frequency and severity of natural disasters within the geographic area. Explanation: catastrophe reinsurance specifically addresses extreme events such as natural disasters, earthquakes, floods, hurricanes, etc., that may cause large losses. Therefore, the primary consideration for the reinsurer when structuring A catastrophe reinsurance treaty is the frequency and severity of such events in the relevant geographic area. While other factors, like the cedent's solvency or premium payments, may be relevant in different contexts, they do not directly relate to the structuring of catastrophe coverage. Question 10. Which of the following best describes the financial impact of retroactive reinsurance? A. Retroactive reinsurance allows a primary insurer to offload future liabilities, reducing their solvency risk. B. Retroactive reinsurance is used to cover claims for past events, enabling a cedent to reduce reserves and improve balance sheet performance. C. Retroactive reinsurance is a form of reinsurance that covers losses as they occur, similar to current reinsurance contracts. D. Retroactive reinsurance applies to future and is not relevant for financial reporting of past liabilities. Answer. B. Retroactive reinsurance is used to cover claims for past events, enabling a cedent to reduce reserves and improve balance sheet performance. Explanation. Retroactive reinsurance deals with past liabilities, particularly for claims that have already occurred. This type of reinsurance allows the cedent to reduce reserves by transferring the responsibility for these past claims to the reinsurer, thus improving the financial performance and balance sheet of the cedent. This is different from current reinsurance, which covers future losses. Option is incorrect because retroactive reinsurance addresses past liabilities, not future ones. Option C is also incorrect because retroactive reinsurance focuses on past claims, not current losses. Question 11. Which of the following is a primary benefit of facultative reinsurance? A. It covers an entire portfolio of risks with one agreement. B. It allows the reinsurer to select individual risks to assume based on their own criteria. C. It automatically covers all future claims made by the cedent. D. It provides coverage for all policyholders of the cedent. Answer. B. It allows the reinsurer to select individual risks to assume based on their own criteria. Explanation. Facultative reinsurance is a form of reinsurance where the reinsurer has the option to accept or reject individual risks offered by the cedent. Unlike treaty reinsurance, which applies to a whole portfolio, facultative reinsurance involves case-by-case negotiations. Question 12. Which of the following describes a loss occurrence in the context of reinsurance? A. A claim that occurs during the policy period but is reported after the period ends. B. A claim that occurs as a result of an event that is covered under the policy regardless of the claim's reporting time. C. Claim made after the policy period has expired but related to an event that happened before the expiration. D. Claim made by policyholder for losses occurring outside the coverage area of the policy. Answer. B. A claim that occurs as a result of an event that is covered under the policy regardless of the claim's reporting time. Explanation. Loss occurrence refers to claim that results from an event that falls under the scope of the policy's coverage. The critical point is that the event causing the loss occurs during the policy period, irrespective of when the claim is made. Question 13. In reinsurance, what is retention typically referring to? A. The amount of loss the reinsurer is willing to bear on a single claim. B. The amount of risk the cedent retains before the reinsurer is liable for any loss. C. The maximum coverage limit the reinsurer provides for any single claim. D. The cost of a reinsurance policy for the cedent. Answer. B. The amount of risk the cedent retains before the reinsurer is liable for any loss. Explanation. Retention refers to the amount of risk or loss that the primary insurer cedent agrees to keep for itself before reinsurance coverage kicks in. This is often the amount of loss that the cedent must pay from its own resources before the reinsurer assumes responsibility. Question 14. Which of the following is characteristic of a quota share reinsurance treaty? A. The reinsurer assumes all losses exceeding a certain threshold regardless of the total premium. B. The reinsurer and cedent share both premiums and losses in a fixed proportion. C. The reinsurer only covers the most catastrophic losses, such as earthquakes or floods. D. The reinsurer assumes the risk of a specific policyholder within the cedent's portfolio. Answer. B. The reinsurer and cedent share both premiums and losses in a fixed proportion. Explanation. A quota share reinsurance treaty is a proportional agreement where both the reinsurer and the cedent share premiums and losses in fixed percentages. For example, a 50% quota share means both parties share 50% of the premiums and 50% of the losses. Question 15. What is the primary purpose of stop-loss reinsurance arrangement? A. To cover specific individual high-value losses exceeding a predefined limit. B. To limit the total loss an insurer can incur over a certain period, thereby stabilizing its finances. C. To provide reinsurance for catastrophic losses that exceed a certain amount in 1 year. D. To allow a primary insurer to offload all claims from a specific type of insurance. Answer: B. To limit the total loss an insurer can incur over a certain period, thereby stabilizing its finances. Explanation: stop-loss reinsurance helps the primary insurer by limiting the total loss it can incur in a policy period. This type of reinsurance ensures that once the total claims exceed a certain level, the reinsurer will cover further losses, providing financial stability. Question 16. Which of the following is not a key consideration when a cedent evaluates a potential reinsurer? A. The reinsurer's financial strength and solvency. B. The reinsurer's expertise in the specific type of risk being insured. C. The reinsurer's ability to offer lower premium than competitors. D. The reinsurer's geographic location in relation to the cedent's operations. Answer: D. The reinsurer's geographic location in relation to the cedent's operations. Explanation: while the reinsurer's financial strength, expertise, and competitive pricing are essential factors for cedent to consider, the geographic location is generally not a key factor unless it directly impacts the reinsurer's ability to handle claims or operations. Question 17. In the context of reinsurance, what does the term ceding commission refer to? A. A fee paid by the cedent to the reinsurer to compensate for underwriting costs. B. A percentage of the premiums paid by the cedent to the reinsurer. C. A commission paid to the cedent's broker for placing reinsurance coverage. D. Fee paid to the cedent when claim is processed by the reinsurer. Answer: C. A commission paid to the cedent's broker for placing reinsurance coverage. Explanation: ceding commission is the amount paid by the reinsurer to the cedent, often through broker, as compensation for acquiring the reinsurance business. This typically covers the cedent's acquisition costs and may be a percentage of the premium ceded. Question 18. Which of the following reinsurance arrangements is most commonly used to cover losses from large, infrequent events such as natural disasters? A. Quota share reinsurance. B. Surplus share reinsurance. C. Excessive loss reinsurance. D. Facultative reinsurance. Answer: C. Excessive loss reinsurance. Explanation: excessive loss reinsurance is commonly used to cover catastrophic losses, such as those resulting from natural disasters. It applies when losses exceed a certain threshold, making it ideal for large, infrequent events. Question 19. What does the term underwriting year refer to in reinsurance? A. The year in which the reinsurance treaty is signed. B. The calendar year in which the premiums are paid by the cedent. C. The year in which the losses covered by the reinsurance occurred. D. The year in which the reinsurer pays the claims. Answer: C. The year in which the losses covered by the reinsurance occurred. Explanation: the underwriting year refers to the year during which the insured events or losses occurred. This is especially important in assessing claims and determining which year's premiums are used to cover those losses in the context of reinsurance. Question 20. What type of reinsurance contract is typically used when an insurer wants to cover specific individual risks not included in its treaty reinsurance? A. Facultative reinsurance. B. Excessive loss reinsurance. C. Quota share reinsurance. D. Stop-loss reinsurance. Answer: A. Facultative reinsurance. Explanation: facultative reinsurance is used for individual risks that fall outside the scope of a treaty. This type of reinsurance allows the insurer to offer specific risks to the reinsurer on a case-by-case basis. Question 21. Which of the following best describes the excessive loss reinsurance? A. Provides coverage for all claims made under a particular policy, regardless of their size. B. It provides protection only for losses above a specific threshold, not for smaller claims. C. It requires the reinsurer to share in both premiums and losses proportionally. D. It covers all losses for a specific time period without regard to the amount. Answer: B. It provides protection only for losses above a specific threshold, not for smaller claims. Explanation: excessive loss reinsurance covers only losses that exceed a specific threshold known as the attachment point. This form of reinsurance is typically used for catastrophic or large infrequent losses. Question 22. In a surplus share reinsurance treaty, what is the primary role of the reinsurer? A. To provide coverage for all claims made by policyholders of the cedant. B. To assume a fixed percentage of each risk above the cedant's retention limit. C. To pay fixed percentage of premiums based on the cedant's total premiums. D. To cover defined amount for each individual loss, regardless of the size of the loss. Answer: B. To assume a fixed percentage of each risk above the cedant's retention limit. Explanation: in surplus share reinsurance, the reinsurer assumes specified percentage of each risk that exceeds the cedant's retention level, meaning that it shares in both premiums and losses above certain threshold. Question 23. Which of the following is not typically covered by reinsurance? A. Claims for loss of income due to business interruption. B. Claims for physical damage to property from natural disasters. C. Claims for medical malpractice by healthcare providers. D. Claims for legal liability related to product defects. Answer: A. Claims for loss of income due to business interruption. Explanation: while reinsurance can cover many types of claims, business interruption losses are typically not included in standard reinsurance contracts unless specifically addressed. Reinsurance generally focuses on physical damage liability or catastrophic risks depending on the treaty. Question 24. In what type of reinsurance contract does the cedant retain responsibility for the first portion of losses, with the reinsurer covering losses beyond that? A. Excessive loss reinsurance. B. Quota share reinsurance. C. Stop loss reinsurance. D. Facultative reinsurance. Answer: A. Excessive loss reinsurance. Explanation: in excessive loss reinsurance, the cedant retains responsibility for losses up to a certain point, the retention level, and the reinsurer covers losses beyond that point, providing protection for larger or catastrophic losses. Question 25. Which of the following is an example of catastrophic reinsurance coverage? A. A policy that covers any loss exceeding $50,000. B. A policy that covers losses due to events such as hurricanes, earthquakes, or floods. C. A policy that provides coverage for claims made for general liability. D. A policy that reimburses for theft and burglary losses. Answer: B. A policy that covers losses due to events such as hurricanes, earthquakes, or floods. Explanation: catastrophic reinsurance is designed to provide coverage for extreme high-loss events such as natural disasters. These events are typically infrequent but cause significant losses, making them eligible for catastrophe reinsurance. Question 26. Which of the following describes a proportional reinsurance arrangement? A. The reinsurer only covers losses above a specified threshold. B. The reinsurer shares premiums and losses with the cedant in a fixed percentage. C. The reinsurer pays for losses in exchange for a percentage of the premiums without a specific share of the losses. D. The reinsurer covers only catastrophic losses in exchange for a fixed fee. Answer: B. The reinsurer shares premiums and losses with the cedant in a fixed percentage. Explanation: in proportional reinsurance, such as quota share or surplus share, both the premiums and losses are divided between the cedant and the reinsurer based on a fixed percentage agreed upon in the reinsurance treaty. Question 27. Which of the following best describes a treaty reinsurance? A. Reinsurance that applies to a single specific risk or policy. B. Reinsurance that provides coverage for specific losses based on negotiation between the cedant and reinsurer. C. A reinsurance arrangement where a reinsurer agrees to accept a certain class or portfolio of risks from the cedant. D. Reinsurance that only covers claims exceeding a specific amount per policyholder. Answer: C. A reinsurance arrangement where a reinsurer agrees to accept a certain class or portfolio of risks from the cedant. Explanation: treaty reinsurance is a type of reinsurance where the reinsurer agrees to accept a broad portfolio of risks from the cedant. This is typically a long-term automatic arrangement, unlike facultative reinsurance, which covers individual risks. Question 20. What is a combination reinsurance treaty? A. A treaty that covers both proportional and non-proportional losses. B. A treaty that only covers large, infrequent losses. C. A treaty that requires the reinsurer to cover losses for a defined period. D. A treaty that applies only to health-related insurance products. Answer: A. A treaty that covers both proportional and non-proportional losses. Explanation: A combination reinsurance treaty is one that blends both proportional reinsurance, where losses and premiums are shared between the cedent and reinsurer, and non-proportional reinsurance, where the reinsurer only covers losses above a certain threshold. Question 29. What is the main reason an insurer would enter into a catastrophic reinsurance agreement? A. To reduce the volatility of its claims experience and protect against unusually large losses. B. To increase the number of risks it can accept within a year. C. To share profits from smaller claims with the reinsurer. D. To transfer most of its operational expenses to the reinsurer. Answer A. To reduce the volatility of its claims experience and protect against unusually large losses. Explanation: catastrophic reinsurance is designed to protect an insurer from large unexpected losses, such as those caused by natural disasters. It helps stabilize the insurer's financial position by providing coverage for severe events that could otherwise result in significant financial strain. Question 30. In a reinsurance arrangement, what is typically meant by the retention limit? A. The maximum amount a reinsurer will pay for a claim. B. The minimum premium an insurer must pay for reinsurance coverage. C. The amount of loss the cedent is responsible for before the reinsurer steps in. D. The point at which a reinsurance treaty becomes effective. Answer: C. The amount of loss the cedent is responsible for before the reinsurer steps in. Explanation: the retention limit refers to the amount of loss the cedent must bear before the reinsurer assumes responsibility for any additional losses. It is a key aspect in both excessive loss and proportional reinsurance arrangements.